Hello, and thank you for joining Nova Healthcare's We'll Show You What's Possible webinar series. Today, we're going to talk about level funding. So what is level funding? Level funding is actually self-funding, but it's making self-funding turn easy. One of the biggest hurdles, I would say, for a smaller employer when they transition to self-funding is having to create a customized plan design. Oftentimes, they're coming from a fully insured program. They bring us a one-page plan summary and they say, I want to be self-funded. Well, there's a lot of benefit questions that go into building a health plan outside of a one-page benefit summary. And what I learned quickly is that the smaller groups, they want the benefits of self-funding, but they make decisions much later in the game. So when we get a one-page benefit summary and we start going back and forth on how they want to cover things, a lot of times they get overwhelmed. And like I said, many of them, they're making decisions much closer to the effective date than a 500 life group. So it becomes overwhelming. And the other big thing is the way the claims are funded. In a traditional self-funded space, the employer pays the claims as they're incurred. And so that dollar amount is never going to be the same. And when that dollar amount's never going to be the same, it could be an accounting nightmare if you don't have the proper tools and protocols in place. And so employers want to be self-funded, but they want it to be quick and easy. They want the benefits of self-funding like transparency, flexibility, but what they don't want is to take on an overburdensome load of administration. So that's really where the level funded program has come from over time. It's really groups wanting transparency, flexibility, everything that comes with self-funding, but it's also quick, turnkey, and easy like a fully insured plan. So basically, when you are getting an invoice in the fully insured space, it is a four-tier rate. And it's the same thing in the level funded space. It's a four-tier rate. But inside of that four-tier rate, there's a handful of different components, right? So there is typically a claims dollar amount. There's a stop loss premium. There might be a TPA administrative fee, a network access fee, a consultant fee. So all of those parts are really consolidated into what looks like a fully insured rate. So now when Nova Healthcare, the TPA, invoices on a monthly basis, it's easy for the employer. We pull that money in-house. We pay all the appropriate parties the fixed costs, and then the larger amount of that premium equivalent is actually a claims dollar amount that we put into a bank account that we manage on behalf of the employer. There's a cap on risk, right? So there's stop loss on the back end. Nova processes claims on a weekly basis. If for whatever reason that there might not be sufficient funds in the claim account, then there's obviously a need for a stop loss claim. And at that point in time, Nova files the claim on behalf of the employer. We get the money from the stop loss carrier and we fund the additional claims. And so those are some of the moving parts that the employer doesn't want to deal with. So in the level funded space, you typically want to work with a TPA that takes on much of that banking burden on behalf of the employer. The other thing is implementation in the level funded space, like I said, is much more simple. Many of the bigger implementations that we've seen are creating custom plan designs from scratch. And sometimes that can take time. It can take a lot of thinking. It's a lot of back and forth. Sometimes it can get overwhelming. And so in the smaller group space, the employers are making decisions much later in the game. And so you might not have that timeline to build out a custom plan design. So those are some of the reasons that people would prefer to go the level funded route. Now, there's a lot of level funded programs out there. There's many of them have been out there for years. There's a few things that I would really like for everyone to consider and ask questions about when purchasing their level funded product. Many of the carriers, the Bucas of the world, they have level funded offerings. But the problem is that they don't manage the level funded offering any different than their fully insured offerings. You might get a little bit of additional reporting, but it's not truly being managed any differently. So when you're looking for the level funded solution, there's a few things you want to make sure that you consider. One is the stop loss contract, right? So you want to make sure that you have a contract that covers run out. A lot of times I have seen immature level funded contracts sold. And basically, the reason that some people are out there doing that is it makes the cost look lower, right? But in the long run, it really exposes the employer to some significant catastrophic risk. So when you're taking a look at your solution potentially, take a look at the stop loss contract. Is it a 1218 that would have 6 months of run out coverage? Is it a 1224 that would have 12 months of run out coverage? Because the last thing you want for with a smaller employer is to all of a sudden have a high dollar claim that isn't going to be covered by stop loss. So stop loss contract number one. Reporting. Like I said, many of the carriers, they don't really give much insight any more than what they do on the fully insured house. So you want to take a look at the reporting and make sure that you are getting transparent reporting that is in a usable format that makes sense to understand what is driving the costs within that population. At Nova Healthcare, our level funded clients that might be 75 employees, 30 employees, they have access to the same amount of data and same amount of reporting that our 500 life clients do. And the reason being is that's how you control cost. That's how you build long-term sustainability of your plan. The third thing, the pharmacy side of the house. So there is a lot of money being spent on pharmacy across the country. It's blowing up a lot of health plans, to be honest with you. And so you want to see how the pharmacy is managed within that level funded program. How is the formulary being built? Is it being to derive utilization to high rebating drugs? Well, that's not necessarily a good thing. A lot of people have been trained to say, you want to know what? I want rebates. But honestly, if I can purchase a drug that's going to accomplish something for $20, I would, without a rebate, I would prefer that option versus $500 for a drug to create a $200 rebate. So make sure there's a formulary that's built upon value and drives utilization to value. One is, are there any specialty copay assistance programs in there? Are there any international sourcing programs embedded in there? A lot of these high dollar drugs, there are ways that we can get them a little bit cheaper than what we do historically. And the final is, what is happening to the rebates? Is the TPA, is the health plan keeping the rebates? They should really be passing 100% of those rebates onto the employer because it's truly a self-funded plan. It's just built to make it be easy for the employer. And then finally, the claims surplus, right? So we're obviously the TPA Nova managing the claims on behalf of the employer. We're putting the money into the bank account on a monthly basis. We're using that bank account to process claims on a weekly basis. If that bank account goes dry, stop loss kicks in. Well, in many instances, that bank account will have a surplus. So what happens to that surplus? That's the final question you want to know. Because many of the carrier programs out there, the BUCAs, if there is a claim surplus at the end of the year, at the end of the run out period, they might only give 50% of that back to the employer. It might be in the form of an admin credit. They might have to renew, right? You need to make sure that you're getting 100% of the claim surplus back because this is a self-funded plan, right? And so 100% of those claim dollars are the employers. So at the end of the year on a NOVA program, after a 6-month run-out period, 100% of that money that is in that claim account goes back to the employer, whether they renew with us or whether they don't. Hopefully they renew with us, especially if they're running well. But for whatever reason, if someone terms, it's a self-funded plan, it's still the employer's money. So those are the 4 things that I would recommend that you look for when evaluating your level funded solutions. So I want to say thanks for taking the time out of your busy day to check this out. Please follow us on our socials, and we'll see you soon.